After a rocky start, stocks rebounded to settle higher on Monday, adding to their gains from the previous week as investors prepared for a busy week of earnings from major technology companies. The S&P 500 increased 1.2%, with a large portion of the gains coming from equities in the technology, healthcare, and finance sectors. Only equities in the commodities and real estate sectors declined. The tech-heavy Nasdaq composite closed 0.9% higher, and the Dow Jones Industrial Average increased by 1.3%. This week, the parent companies of Apple, Facebook, Amazon, and Google will all release their most recent financial reports. As some of the most expensive stocks in the benchmark S&P 500, their earnings this week may have a significant impact on the direction of the broader market. According to Jack Janasiewicz, portfolio manager and head portfolio strategist at Natixis Investment Manager Solutions, the market is generally taking it easy and there are a few data points people are waiting to see. At 3,797.34, the S&P 500 increased by 44.59 points. To reach 31,499.62, the Dow advanced 417.06 points. To 10,952.61, the Nasdaq gained 92.90 points. Small company stocks increased as well. To close at 1,748.40, the Russell 2000 index gained 6.16 points, or 0.4%. Bond yields ticked upward. The 10-year Treasury yield spiked briefly to 4.29% before falling to 4.25%. Late on Friday, it got to 4.22%. The yield on the 2-year Treasury increased to 4.5% from 4.48%, generally reflecting investors' expectations for Federal Reserve action on interest rates. Stocks rose on Friday after comments made by the head of the Federal Reserve Bank gave traders hope that the institution could think twice about speeding up its aggressive rate increases in an effort to contain inflation. The Federal Reserve Bank of San Francisco's president, Mary Daly, stated that she has been considering the risks of raising interest rates too high and harming the economy too much. She stated, "I think the moment is now to start talking about stepping down, even though the Fed probably isn't quite ready to start reducing the amount of its rate hikes just yet. The moment has come to begin making plans to retire. Interest rates and the Fed are crucial," he said. Investors are carefully examining the most recent batch of company profits to have a better understanding of how inflation is affecting various sectors of the economy. Prices are still at their highest levels in 4 decades for everything from food to clothing. As a result, businesses have been forced to squeeze customers while raising prices and cutting costs. In an effort to control inflation, the Federal Reserve and central banks throughout the world have been boosting interest rates. As less risky bonds appear more appealing in a volatile stock market, rising interest rates have been putting pressure on more expensive stocks, such as those of technology companies. Because of the Fed's rapid rate rises, investors and analysts are concerned that the institution may go too far in slowing the economy and cause a recession. The American economy has already started to slow down and actually shrank in the first half of the year. On Thursday, the government will present its report on the third quarter's gross domestic product. At its upcoming meeting in November, the Fed is anticipated to increase interest rates by another 0.75 of a percentage point. The market has been watching for any indication that the central bank is prepared to scale down its rate hikes. The final rate must be discovered by the market, according to Janasiewicz. "I believe we can start to establish some footing once we are comfortable with that." After President Xi Jinping re-elected himself as the head of the dominant Communist Party, stocks in China fell. The revelation shook some major Chinese corporations' US-listed stock. JD.com dropped 13%, while Alibaba sank 12.5%. Concerns about China's economic growth being hampered due to excessive centralized control are raised by Xi's desire for a larger Communist Party role in the country's corporate and technological development. The severe COVID-19 limitations are still having an adverse effect on China's economy. Matt Ott and Yuri Kagiyama both contributed to this report.